This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hey everybody, thanks for tuning in. This is Mike Mansfield with The Wealth Puzzle from the Lynn Group. I'm by myself today, no Tana, unfortunately. Just wanted to touch base with everybody. So since last Friday, the stock market's been selling off pretty hard. We're getting a lot of phone calls, a lot of emails. I realize the visual angst that represents. And so I wanted to put a little perspective. Is this a crash? Is this a correction? What is going on? And so oftentimes when markets are emotional, as we feel they're being right now, you have to start to question yourself, why? And is this a bigger problem that's shaping up? Is it a short-term problem that's going to cycle back up? Remember, the stock market is supposed to be like a heartbeat. It's supposed to go up and down. And the problem is for the last year, the thing's been pretty steady Eddie going up. Last April, we did have a correction in the S&P 500 of about 5%. Guess what? Nobody even remembers that. It happened just a few months ago. And then a month later is at all-time highs. So right now, the S&P has sold off pretty healthily. It's down about 8%. But ironically, year to date, it's still up 8 or 9%. And if you look at it over the last 12 months from last August, the market's up 16, 17%. So in totality, the market is still grinding higher. It's still in a good place. Obviously, the sell-off is unpleasant. To be fair, I think that the stock market got a little ahead of itself, right? You know, it went up over 5,600, the S&P 500. That's where we ideally felt the market would be towards the end of the year. So it was wild and exciting to get there a little quickly. But remember, Tana and I all year, we've been talking about what we called the three-legged stool. What were the three things that were going to drive the stock market higher? The presidential election, which is only wrought with chaos at the moment, right? But statistically, those are good market years, especially when you get into the fourth quarter. The Feds, if the Feds cut rates, which has been problematic this year, and we're going to talk about that in a second. If they cut rates, that's like steroids in the stock market that generally grinds the market higher. And then year over year earnings. And so those are the things that will continue to stabilize and dictate what the market does. So the election's its own mess. I don't need to talk to you guys about that right now. I think everybody sees kind of what's going on. We're going to have to get a little closer to the election to see how the polling is shaping up, to see how that's going to dictate things. Earnings are very interesting. Here, let me kind of pop something up on the screen here. So year over year earnings as of today are at 11.5% annualized earnings. That's really good growth on the S&P 500. Now, just at the end of last quarter, we were only at 9%. So earnings have actually accelerated from the earnings that we're getting out right now. This is mathematically positive. So, but the stock market's going down. It's scary. So we're really excited about how earnings are doing. Obviously, there's always the inherent concern of, are those earnings being driven by consumer demand? Are they being driven by federal government deficit spending? So there's some different things that dictate it. But at the moment, earnings are very positive, at least in totality. There's a lot of those earnings that are disproportionately skewed to the top end of the S&P 500, meaning those big companies, the NVIDIAs and things like that. So a little problematic there, but overall we have good earnings growth, which certainly supports a higher S&P 500 value. Then we get to the pesky Feds, right? So the Feds came out last week, and even though they didn't promise, they basically alluded that they're cutting in September. In fact, at the moment, there is a 0% chance prediction that they're going to keep rates the same in September. Last week, there was about an 80% chance that they would do a quarter point rate cut. And here you can see the CME Fed Watch tool that we like to use for the September meeting. At the moment, there's an 80% prediction that the Feds would do a 0.5 point cut. That's shocking. That's huge. So one way or another, the Fed's talking cuts. Everybody's betting on cuts. On top of it, the Fed was very promising of what they call quantitative easing, which if you and I have to oversimplify that, that means printing money. Now, when you look at the history historically of the Fed's cutting and quantitative easing, all those things, statistically, the market actually does go down. It's kind of boring. It's kind of pouty for a couple months, and then it cycles back up. Because remember, when those rate cuts hit the economy, sometimes taking 60 to 90 days, what happens when mortgages are cheaper? What happens when car loans are cheaper? When business loans are cheaper? The velocity of money speeds up. People borrow at a quicker rate, and that borrowing accelerates equities and markets. So at this point, barring something much bigger happening, I'm a huge advocate of saying there's not an immediate recession going on. And the reality is the stock market will probably be at all-time highs by the end of the year. So at the moment, not too concerned. Even this morning, right before I started making this video, manufacturing data came out. The ISM services thing came out, and it was a 51.4. Not that you have to know what that means. Is a number below 50 bad, a number above 50 is good. This was the best reading on this data point since 2021. And so it's kind of countered the market. It kind of pulled it off of its lows today of saying, hey, wait a second, economic data isn't as bad as we thought. Remember, there was a bad jobs report on Friday. That's kind of what got the ball rolling in the conversation. There's certainly some angst floating around about Iran and Israel. But, once again, we've kind of lived through that stuff, right? And you have to dictate how that affects the bottom line of the stock market. Iran had a big figurative attack in Israel back in April. The market went down a little bit, and then it said, just kidding, and cycled back up. Same thing happened when Russia invaded Ukraine. Same thing happened when Hamas invaded Israel. These are very emotional short cycle events in the market, because at the end of the day, if something doesn't truly hurt the bottom line of a US-based company, then that US-based stock can certainly hold up through those types of political market cycles and geopolitical issues. So in totality, at the moment, everything is straightforward. Now, I've done this before, right? If you go check the tape, look at all the videos Tana and I talked about. We've talked about the skepticism of economics. But remember, economic skepticism is different than stock market performance. These two things do not go in a straight line. Economically, there really are problems, right? In the last couple of years, the federal government has created most of the jobs. So as the labor market falls apart, you say, well, wait a second, was the feds just propping that up? A lot of the spending can be coming from the feds. They talk about the consumer being really strong, spending money, but credit card debt hitting all-time highs. So there's a lot of hinky things going on. Even though when the feds cut and do quantitative easing, even though that's good for stocks ultimately, it's really problematic big picture. So we're looking at the short term, that 6 to 12 month burst of excitement that will come from that. But we have to be very, we'll say, skeptical big picture of how this stuff is shaping up long term. And so those are obviously things that we'll keep making videos and sending out to everybody. But just so you know, at the immediate moment, I'm not very concerned about the stock market being down. In fact, this is kind of starting to get to the moment that, hey, you know what? If you have a lot of conservative money sitting on the sidelines and you've been waiting for an entry point in the stock market, this might be the moment that you stick your big toe in. So anyways, if you have any questions, thoughts, concerns, curiosities, please reach out to our office, 805-500-7035. You can certainly visit our main website, thelindgroup.com. We hope that everybody is safe. Just relax. It's all going to work out. It always does. That's the phenomenon of the markets. But don't hesitate to call and reach out if we can help out with anything. So in any case, everybody have a great day, and we'll be back soon. Bye-bye.